Hi, we all know the economy basically exploded in 2008, but why? We can attribute a large part of it to CDOs and CDSs, two fancy types of financial deals that seemed okay at the time, but were actually horrible for individuals and for the nation. Let's start with CDOs. Collateralized debt obligations, or CDOs, were created as a bridge between homeowners and investors through mortgages. Prior to 2008, other than bonds, mortgages were seen to be the safest investment. Investors felt comfortable investing in mortgages because, prior to 2008, house prices had always been rising, meaning there was an almost guaranteed return profit. To make this explanation simpler, let's take two guys, Carlo and Paulo. Let's say Carlo wants to buy a house. A recent Princeton graduate with a wife and kid on the way, Carlo is ready to settle down. As a fiscally responsible citizen he and his wife save up for a down payment on a house and get a mortgage. They feel comfortable because they know house prices will continue rising, so they'll make money when they sell for a larger house in the future. Carlo and his family move into the house, but beyond his life, Carlo's mortgage broker sells the contract to an investment banker for a nice fee. The investment banker buys a bunch of other mortgages too, and puts them all into a metaphorical box. Now the investment banker gets all of the monthly mortgage payments as a profit, which is good. But because he's greedy and in finance, he sees room for even more money. So he splits up the investment into three sections: safe, okay, and risky. This, in short, is a CDO. The three sections essentially act like three cascading trays that the monthly mortgage payments flow into. The safest section is always the one that's most likely to be filled by the payments, and if people default on their loans, the riskiest does not pay off. But when it does, it has a higher return rate as incentive, making it popular with hedge funds. Banks, companies, and hedge funds each purchase sections of the CDOs based on the risks they're willing to take, and everyone's making a profit. Everyone's doing great, so the banks, companies, and hedge funds want more. They call the investment banker who calls the mortgage brokers, but there are no more mortgages to sell because all of the people qualified for them already have them. This is where the problem starts. Because all of the people that are qualified for the mortgages already have them, the standards are lowered. That's when people like Paulo, who has no proof of income and no savings, gets a mortgage. With these lower qualifications, Paulo, his wife, and his 7 children get a mortgage they wouldn't have been able to get before. This is a subprime mortgage. Investment bankers weren't worried about the effects of the decreased requirements at first because house prices are always rising. So if Paulo defaulted, they'd own his house and just sell it for a profit. So the mortgage brokers gave out subprime mortgages, the investment bankers bought them, and they made new CDOs. This changed the meaning of safe and risky, as safe in a box of subprime mortgages is still pretty risky. But with the for-profit rating companies doing their bidding, the investment bankers could sell these CDO sections however they wanted. Of course, some of the people with subprime mortgages pretty quickly defaulted on their mortgages. That was okay though, the investors just put the houses on the market. Until every subprime mortgage holder started to default. Houses were going up for sale everywhere, and there were more houses than people looking to buy them, leaving investors and investment bankers with nothing but dozens of worthless houses. The investment bankers not only had nothing left to sell, but they had millions of dollars in debt to repay from taking out loans to buy the mortgages in the first place. There was bankruptcy in every facet of the economy, and when individual investors called to check on their money, they learned that their investments were worthless. Basically, everything exploded, but that's not even the worst of it, because we still have to talk about credit default swaps. In its most basic terms, a credit default swap, or CDS, is insurance. Leading up to 2008, getting a credit default swap was popular with CDO holders. These investors would form credit default swap agreements in case the owners of the mortgages in their CDO would default on loans. These tactics were even more likely to be used if the CDO mortgages were in the riskiest tier, or were subprime. An owner of a CDO, let's say he's the manager of a hedge fund, would approach an insurance company like AIG. The two would form an agreement in which the hedge fund manager would pay a fee to the insurance provider, and the insurer would, ensure that his client's potential losses would be covered. To make this simpler, let's use a more relatable example. Let's say you have a really nice bowling ball. Most likely your bowling ball isn't going to get run over by a car or stolen by a robber, but there's still a small chance that could happen. So you go to an insurance company and get bowling ball insurance. You'll pay that company a monthly fee, even though they won't really do anything from month to month. But the point is that they'll be able to pay the $3,000 replacement cost for your epic bowling ball all at once if something does happen to it. This seems to make sense at first. The insurance company gets a monthly fee, and the CDO holder gets the peace of mind that they won't lose everything if their investment goes bad. Because mortgages were supposed to be stable, insurance companies had no problem insuring tons of CDO investors. The problem in 2008, however, was in the contents of the CDOs and in the sheer number of bad ones. Companies and businesses had invested in these disguised, risky CDOs and then taken out insurance on them, which was fine until people started to default on their mortgages. As a CDO would suddenly fall in value and its investor was left with worthless houses, the investor would come to its insurance company and ask for the large sum they had agreed upon. Sure, the investment company could pay this amount and fulfill its contract, until suddenly every owner of every CDO with every credit default swap came looking for their money all at once. The insurance companies simply could not pay this much money at one time, as the fees they had received were nowhere near totaling the amount they owed their clients. As a result, the companies went out of business, the investors lost all their money, and the economy plummeted. So there you go. That's how CDOs and CDSs messed up the investments of people all over this country in ways that will unfortunately be felt in people's savings accounts and in the nation's fiscal debt for quite a few years to come.